The corporate reconstruction and reorganisation of a business is probably very apt given the recent economic history that we have had, given the fact that many companies have struggled following the banking crisis that led many countries to fall into recession in the last few years. Those companies have struggled financially. They were either loss-making or they were losing value. Now, what a company has got the choice of is, one, it can reconstruct. It can try and go through there, following financial difficulty, try and increase a firm's value. Or, alternatively, what it can do is it could reorganise. It could potentially divest part of its business to get rid of that loss-making part and then to focus, if you like, on its core activities. So the syllabus is, in this area, split into two. First of all, we'll look at your financial reconstruction, and then we'll go through and look at your business reorganisation. So, to go through first of all and look at your financial reconstruction, what we have there is it's looking to try and prevent business failure. Yeah, the company has been struggling, it's been making losses, but we don't want to go through and get rid of the business. We want to try and improve its performance. We want to go through and increase your shareholder value. At the end of the day, we'll need to start thinking, does this reconstruction scheme actually change the shareholder value? Does it increase the value of the business numerically? Now, what we're going to do is we'll look here at part one, which is the discursive aspects, which is great. It's knowledge, it's facts, we can learn it, as we've seen with other parts of the syllabus, and do quite well. We'll then have a look in part two at the numbers, a little bit more difficult as it's technical in nature. So what you have here are three ways of looking at a financial reconstruction. You've got there a leverage buyout, a leverage recapitalisation, and debt for equity swaps. And a company will go through and undertake one of these reconstruction schemes to, if you like, prevent liquidation, whether that be there a forced liquidation or a voluntary liquidation. Because by entering into this scheme, it can go through there and benefit, if you like, from new forms of capital. It may be that the company isn't in financial difficulty, it just wants to go through and improve shareholder value, so wants to raise new capital via one of these schemes here. So let's go through and have a look at each of them in a little bit of detail. The first method of corporate reconstruction is looking there at a leveraged buyout. What you have there is a company that may be struggling that is then bought out by another company by means of using debt finance. And once that company has been bought out, that bought out company will no longer be listed. So the key here is that you are currently a listed company being bought out by another company that will then delist you, that then uses debt finance to purchase your business. Now here, when we're looking there, one, at the debt finance, what happens there is that the purchasing company will go through and issue bonds by use of a special purpose vehicle or a special purpose entity. A prime example is the 2007 acquisition of the UK steel business Chorus by Tata. Here, what they went through and did is that they went through, and you would have had at the top Tata, who was the acquiring company. You had their target, which was there as Chorus. And then what you will have there is your special purpose vehicle. So the special purpose vehicle is set up by the acquiring company to acquire that target company. And it's here whereby in the special purpose vehicle that large amounts of debt finance will be raised, and then that debt finance will then be put on the financial statement, so the balance sheet of that target company. So when we look at the amount of debt finance that was used by Tata, Tata used somewhere in the region of $7 million worth of debt out of a $10 million financed acquisition. Now, what we have to go through and do there is we need to look here to start off by looking at Chorus. You know, if you go through and think about the downside of being taken over by another business in your reconstruction and then becoming delisted, what you have there is that, if you like, The disadvantages are: 1, your loss of status, and then 2, there is then a lack of marketability of the shares. So if you are no longer listed, the shares can no longer be bought or sold, and then there's a status symbol with being listed. However, there are plenty of advantages. The first one is that you are now no longer listed, so therefore you have less costs in respect of your listing requirements. Likewise, if you're no longer listed, then the company is protected from your changes in share price. If you have now been taken over, the shares are no longer marketable, then you are less susceptible to future takeover bids. What you have then, if you look at what we have done, we've taken out lots of debt to acquire that business. Well, you need to make sure that you manage the cash flows well. So what happens there is that you can then concentrate on the long-term future. You're not just thinking there about surviving in the short term. You've got all this cash, you can then use it and put it to good perspectives. What you also have as well, coming back to the very early part of the syllabus, let's go through there and think about agency issues. If you're thinking about agency issues, then you've got less, if you like, because you're now only responsible to one group of shareholders. You're just responsible there to Tata's shareholders. Previously, you had various different forms of shareholders, and there were therefore more agency issues, but now you've got, if you like, closer relationships. In order for this to go through and succeed, we need to make sure that, first of all, that within Chorus, it does have strong cash flows, so it is actually generating sufficient revenues. It could just be that the costs were previously not controlled. It also needs to be the case that we have low levels of existing debt. And as you are raising finance as well, you need to have there a strong asset base to ensure that you can use that as security for this debt-financed acquisition. What we saw when this takeover happened was that a lot of disposable assets, assets that were no longer needed, were sold off. That then helped generate some cash flows early on within this leverage buyout, so that management could then go through and focus on those long-term cash flows. The second method of a financial reconstruction is looking there at a leveraged recapitalisation. So leverage, again, we're talking about debt. So we're looking there at trying to fend off an acquirer by taking on high levels of debt. We go through there and, in effect, reconstruct our business by taking on board more debt. And then once we have that debt, we can then use that debt to go through and pay off the shareholders. By paying off the shareholders, what we're going to have there is there will be less shares on the market. So what should happen there is that there is an increase in shareholder value. Now, just be careful. We spoke about reconstructions as an option to ensure that we don't have to liquidate a company, but we also said that it doesn't necessarily mean that a company has to be struggling. Here, this is a prime example of where a company would not be struggling. It is there just trying to increase shareholder value by reconstructing its financial statements. It's issuing more debt. It's then going to go through and take on board that debt to use to pay your shareholders, which ultimately increases the shareholder value, as there are then less shares on the market. Debt for equity swaps are looking at a reconstruction scheme whereby a company is struggling. What we have here is that a company has gone through and taken on board lots and lots of debt finance to be able to go through and improve the business, if you like, to try and increase shareholder value. It was there investing in new projects. However, what's then happened is that where they've invested the cash and the funds in those new projects, it's maybe not been as successful as what was originally thought. And what then happens is that you can no longer pay the debt that you have taken on. So you are faced with the threat of being potentially wound up. You are faced with liquidation. So what you can go through and do is you can approach the debt holders. You can approach the banks or the investors. And what you can do is enter into a debt for equity swap. So what will happen is that the debt will be cleared. However, when the debt is cleared, it's cancelled and you give shares to the debt holders instead. Now that's good from the company's perspective because it no longer needs to meet the interest payments. However, what happens there is that the shareholders in the company do suffer a dilution of control. But then we start thinking, well, if you're a bank, why are you going to go through and take a share in a company that isn't performing very well? Well, hopefully what will happen is that you will get a return in the future. Let's face it, if the company cannot pay the debt that you are owed, you're not going to get any return whatsoever. If you wind the company up, you'll get a minimum return. By allowing this debt for equity swap, so taking the shares in return for the debt that you are owed, you could then get a return in the future via capital growth or by some form of dividend. Because at the end of the day, this debt for equity swap saves the company from being wound up. If the company's wound up, the shareholders won't get much, the debt holders won't get much. But by doing a debt for equity swap, OK, the shareholders suffer a reduction in their level of control, but I'm sure you'd be prepared to take a reduction in your level of control to get more in the future from your shares. Similarly, from the lender's perspective, they aren't currently getting any cash. They are more likely to get cash if they then can force the business to perform better and then get capital growth or some dividend return.